Hello, everyone. Welcome to another edition of Tip Tuesday. Geoffrey Nance here with you. Today's topic is options. So, what are they and why should I care? In the industry, they're moving more towards calling them options, but years ago, they used to call them a fancier term called derivatives. Now, why did they do that? Probably for a couple of reasons. One, derivative sounds a lot harder than option. Option is just like, oh, you could do this or that, right? So it seems fairly simple, like almost like you could do it. If we call something a derivative, it's like, some people may not even know what that means. So obviously that sounds harder. Probably can't figure out how to do that on my own. So I'll just need to let somebody else handle that. But a derivative is an appropriate term because it is how this works. So an option is an entity, if you will. It's a thing that allows you to either buy to open or sell to open a position, and you can use this option for multiple um benefits to you potentially. There are a number of different things you can do with it. You can put them in combination with a number of things. So we'll kind of go over some of that. Now, we're not going to teach our full step 2 through 4, obviously, over the next 10 or 15 minutes. But we are going to at least kind of give you an idea of what they are and how you could use them. But as a derivative, what that means is that something gets or attains its value because of something else. So in other words, what's the value of anything? Our pastor said a long time ago that the value of anything is what somebody is willing to pay for it. Well, it's a pretty good assertion. So when you start to think about that, like what is the value of something? Well, you go to like a car, like the manufacturer's suggested retail price is like, all right, but then what's the actual price? And you say, well, it's this. But then you've got the haggling going on with the dealership, and then like, are you trading in a car? And so what's the real price on this? So the value is actually derived from something. That's what somebody is willing to pay for it. Well, particularly with an option, there are many, many options. So there's only two types, right? So only two types. There is a call option and there is a put option. And basically, owning these options gives you the right to do certain things. So, for example, with a call, it allows you the right to buy the stock at a particular price if you do that on or before the expiration date. So, it is the right to buy. The right to buy what? The right to buy the actual stock. You have the right to buy the stock at a certain price. Now, what is that price? Well, that is determined by the strike prices. Who makes those strike prices available to you? That's the market maker. So if you go into what's called an option chain, you'll be able to find a long list, all right, a long list of options. You have a long list of calls. You have a long list of puts. But choosing one of those, and then obviously, so that's one list. But you're going to have, like, some of them have what they call weekly expirations, and basically those options expire on Friday. So every Friday, that particular set of options would expire. They would have a new list for the following week. They'd have another list for the week after that, etc. And you could go out as far as 2 years. In fact, if you go out like 2 years, that's actually called a leap, which is just a registered term for the Chicago Board of Options Exchange. It's just a fancy way of saying this is a long-term equity position, right? It's a long-term equity anticipation security is what it stands for. And basically, it's just holding an option for, in theory, right, a long period of time because you think that this thing is going to increase in value. And you say, well, what would be the point of that? Why would I want to hold an option for a long period of time? Well, because options provide leverage. Options are normally quite um, cheaper than the actual stock. So, in other words, if I were to go out there and say, all right, like this stock cost me, you know, $30, well, I could go out there and probably find a reasonable option for $4, $5 a share. So, rather than saying, okay, I can go 1,000 shares for $30,000, I could control 1,000 shares for maybe 3,000, 4,000, $5,000. So obviously when you think about risk, I've got 30,000 in this trade, or I have 5,000 in this trade. One of those is obviously way lower than the other. So that's one benefit of options, is that it provides me leverage, so I can go out there and control more shares. The other things that I can do with options is I can buy what's called a put option. A put option gives me the right to sell the stock at the strike price on or before the expiration date. Now you might be thinking, okay, well that's kind of interesting. What would be the point of that? Why would I want the right to sell something? Well, let's just say you own a stock, um, and you say, all right, I want to go, sell this option up here. I can sell a call option, and if somebody else decides they want to buy it, then I can sell it, and then I can make the money from selling. Because obviously, if I'm selling, I'm bringing in money, so I can sell it at that price, but I already own it. So now I can kind of lock in that, oh, if this gets called out or exercised, we're not going to go into all that terminology today, but if that happens, I would make X amount of dollars. So I would get the essentially money that I brought in from selling to open, and then I would also get the difference between where I bought the stock and what it's worth at that particular time, or at least where the strike price comes into play. So you can use it to do some things like that. You can also use options in some really creative ways to fix trades that don't go your desired direction. There's a lot of different stuff you can do. You can also enter a position with what's called hedging. So you can go out there, and let's just say in general, you think the stock is going to go up, but you're concerned that it could drop. You can go buy a put. What benefit is that to you? Well, if you go buy a put and the stock drops, puts gain value as the stock drops in value. So here you have a position where you thought, oh, this is going to increase in value, but I just want to protect myself in case it drops. Well, buying a put would allow you to do that. Now, we're not going to go into too much more detail as to buying and selling and all that stuff, because you do have to really think through it. So a call increases in value as the stock goes up. A put increases in value as the stock goes down. So most people don't even really realize that you can actually make money on stocks when they go down, but there are actually a couple of ways to do that. One is you can short the stock. Now it certainly carries some risk with that, or you can buy a put option. Now, obviously, buying the put option uh, is going to be less risky. You have less money involved, but when you short it, you're selling to open. So technically, you didn't pay for it; they paid you up front, but it carries quite a bit more risk. So most of our students they feel like a stock is going to drop, they're going to buy a put, watch that thing increase in value. And just like anything, guys, I mention this all the time, particularly when I'm teaching our step 2, where we really dive into what options are and how to use them, is to remember this. It's a real simple way of thinking through really anything you're going to do in life. But just because you're dealing with options doesn't change how math works. Okay. So if I buy something, if I'm going to make a profit on it, it always has to increase in value when I sell it. So in other words, if I buy it for $2, I need to sell it for 3 or 4 or 5, etc. But I need to sell it for more than my original purchase price. And if I don't do that, then I didn't make money. And that's true whether it's a call or a put. If I buy it, if my action is to buy to open, I have to make a profit. So in other words, what I paid for, what I bought, has to increase in value. And that's where this gets a little tricky here, because you kind of have to think through, well, how does the call increase in value? How does a put increase in value? And for most people, thinking through a call is actually fairly easy. But when it comes to the puts, they kind of get confused a little bit, going, wait a second, I don't understand. How does it make money? Do I want it to go up, or do I want the stock to go up? Or no, I want the stock to go down, but I don't understand, why does the put gain value when the stock goes down? Well, remember, a put is the right to sell. And so basically, remember, we want to buy low and sell high. So essentially, if you're in a position where you need the stock to increase in value, you need to buy low. If you're in a position where you want the stock to decrease in value, you want to sell high. So we want to buy low and sell high. So you can kind of think through what that might mean for you. But obviously, a put is a great opportunity when you see the market decreasing in value, or a particular stock decreasing in value, for you to go out there and take advantage of a move down. If you don't have options, then you are somewhat limited and what you can do. You're basically just a buyer of stock. However, when we bring in the ability to do options, particularly when we can combine options and do multi-leg options, and that would be something like a spread. So when you hear that terminology, it's a spread. Basically, all it's saying is it's some combination of multiple calls or multiple puts or some combination of calls and puts where you have multiple legs at the same time. What we're going to focus on primarily are going to be what they call um, diagonal or vertical spreads, because the when you go to the option chain, you're going to see that there's just a bunch of prices listed. Those are your strike prices. It's the price at which a transaction would take place. So remember, for most of us, we're going to be using these to kind of leverage our money. So we're not really going to go out there and convert the options into stock, even though that's what you have the ability to do. We're just going to try to buy something for a smaller amount, sell it for a higher amount. That's what we're trying to do. Or sell it for a higher amount and let it lose value and then buy it back, or let it expire worthless at a smaller amount. Okay, so buy low, sell high. And again, what you're really thinking through is, what is a call, right? So a call gains value as stock goes up. What is a put? It gains value as the stock drops. So you got to kind of think through, well, what am I wanting to do? And then what I want the stock to do, right? So the stock's going to do whatever it's going to do. All you're trying to do is take advantage of it, or to say, you know what, this trade isn't really going the way that I want it to. I wonder if there's some kind of fancy things that I can do to fix this trade, and you can do that. There are some things that you can do where if you get into a trade and it's not working, by dealing with options and using options and your knowledge of options and how they work, you might be able to buy yourself some time, or to even bring in some credit, lower your cost basis while you wait for that trade to turn around. Now, we don't want you to sit there forever and do this, because eventually that won't work, but there are some things that you can do. Options are a great opportunity for you to really take advantage of two things. One is volatility. So when you're seeing a lot of movement, the options are going to increase, but also, word of caution here, decrease at an exponential value. So while it's cool to think, oh, this stock is going up, I'm making a much higher return on investment, the reality that you also need to realize, and why we don't want you to just simply say, oh, this sounds cool, I listened to Geoffrey talk about options for 15 minutes. Now I'm ready to go out there and start trading these things. The downside is that they also can lose a high percentage very quickly. So the thing that's a real benefit, oh, I can get a higher return on investment, much higher return on investment than buying the straight stock. Absolutely true. But you can also lose a higher percentage with options. So there are certain things that we do through our teaching to kind of help you get more familiar with options, how they work, but also to understand, if I do a short term, what are the pros and cons? If I do a midterm, what are the pros and cons? If I have a long term option, what are those pros and cons? So just thinking through that, thinking through the combination as well of what I can do with multiple calls, buying this one, selling that one, getting this essentially at a discount. What does that look like? Being able to write covered calls. What does that mean? What are the pros and cons to that? We want to walk you through that entire process. And so if you've never been through our courses, we would encourage you to do that. Of course, we have follow-up available for those that have attended, but hope that this has been helpful to you today to understand what options are, why they are a good opportunity for you to be able to trade those, to take advantage of a couple of things. One is the leverage they provide, but then two, the opportunity to go in there and kind of adjust some trades that you might be in to maybe fix some things or tweak some things, or at least at the minimum, lower your potential expense on that particular trade, because you know how to use options. And then basically think of options as puzzle pieces, and you're putting together this giant puzzle, but the more you understand where the puzzle pieces go and how they fit together, the more complete your puzzle will be. And we want you guys to have everything you need to be able to be the kind of traders that you want to become. So let us know how we can help you. We do believe that options are going to be a big part of this. And so we want you to learn as much as you can about that. And just like anything, that knowledge is going to increase over time. So don't think you have to know everything now. There is a learning process, and we want to help you through that. All right, guys, thanks for being a part of Tip Tuesday. We'll see you next time.